Welcome, Accounting 202, Fundamentals of Accounting 2 students. This is Professor Hassey, and this is our introduction video to our first week of our course. This first week of the spring semester, February 1st and 3rd at 9:25 in the morning. I'll be doing this every week prior to every week of our class, introducing our topics. But this week, especially the first video is just to introduce the course, give you some reminders about being prepared for our coursework this coming first week of the spring semester. And I welcome you all. Hope you all are doing well, your families and you are healthy. This spring semester will be a remote class via Zoom. The links have already been sent to you in my introduction email to the course. Uh, we will not be meeting in a classroom. I'm sorry to say that. And I know a lot of you in this class are either second semester freshmen or sophomores. And I feel sorry that we can't share the campus experience, but trust me, I think if everything goes according to plan, we'll be back on campus this coming fall. And then I can see you live and in color. So today we're just going to introduce the first week. This is our agenda for the first week, what we're going to be trying to accomplish. Our topic for this week is financial versus managerial accounting. What is managerial accounting or accounting 2? Just learning the basics, making sure we're going to be looking over some exercises on Wednesday, and just get prepared for our course of study for the coming semester. To prepare for this week, I'd like you to get familiar with our course syllabus and schedule that I've sent you. Also, it's located in our Blackboard, and I'll show you that in just a minute. This is our our link to our class on Mondays and Wednesdays right there. We have student hours on Tuesday and Thursday afternoons. If you need to talk with me about anything, go over any material. And then a definition of the course. The topics we'll be covering are grading. This is a attendance mandatory class. I expect each one of you at every class. If you cannot make class, you need to let me know that you're not going to be there. I don't need to know the reason why. Just send me an email or a text giving me notification of not during the class, but the day before or the evening before class, letting me know you will not be there because I will be taking attendance. This is a mandatory attendance class and you will be, it'll affect your grade if you miss a certain amount of classes and you don't notify me of that. Also, I would request that you turn on your cameras for our class at this ungodly hour of 9:25 in the morning. But that is not mandatory. If you do not want to turn on your cameras, that's okay. But I would prefer to see all of you on camera to help me lecture and help me ask you questions and get some engagement from you during the course of our class time. But again, cameras are not mandatory, but I would appreciate it if you do put them on. Okay, so again, get familiar with the syllabus if you've not already done so. Our textbook is required at 8th edition of the Managerial Accounting Wiley Publishing textbook. And also be familiar with our course schedule and the dates of no classes. We don't have class on Monday the 15th, when our first quiz is, our examination, and so on. So please go over this, and these are problems that we will review during the course of the week. These are not problems for homework to turn in. They're just review problems that I will discuss in class. Here is our Blackboard site, which I hope hopefully by Monday morning you have looked at a little bit. Again, this is a lot of you should be pretty familiar with Blackboard and its uses. I have our class all mapped out. Every week of instruction is mapped out with PowerPoints and materials. Please take a look at it. Here's our first week with our course agenda. This video that I'm doing right now will be posted to this week number 1. A definition of some of the definitions of managerial accounting and some review problems and such. This Blackboard has been set up for every week of our course, and you can see what we're going to be doing throughout the semester of our course. Also, under course information is our syllabus. a variety of information that you have to get prepared. And if you also a picture of the best picture of me, my ugly mug is being hidden, and my definition for some of you who do not know me, but I know many of you who will be taking this class. So that is our Blackboard. Get up to speed with it. Make sure you understand what's going on, and I would appreciate you doing that. But before we close out this introduction video, I want to give you a brief video to get you prepared for our class this first week, the definition of financial and managerial accounting. So let's take a look at that video.
So we're going to talk about managerial accounting. Now, most of you probably heard of financial accounting. You know things like income statements and balance sheets. But managerial accounting is different because it's basically for managers. Okay, so when we talk about managers, what we're talking about is that we're going to create some information, some info within the firm, and then we're going to give that info to managers to help them. So you might be thinking, okay, well, what kind of information do managers need? Why do they need this information? What are we doing here? So let's just think about an example here. So let's say this example that you start a business that you're going to manufacture furniture. So you start your own business, you're going to manufacture furniture, and it becomes a pretty large furniture making organization. You have a lot of different divisions, and you're trying to run this company. And now we're going to figure out, how does managerial accounting, how is that useful to you in your organization? So the first way we can think about managerial accounting being useful, we can think about it in terms of helping with planning. Now, you might think, okay, well, I can plan for my organization without managerial accounting. What does this have to do with it? Well, a big part of managerial accounting is coming up with budgets. Okay, so we're going to have, a marketing budget. We'll have budgets for all the different divisions based on what we expect that they're going to end up spending. We can budget out all different types of costs. What we think this is going to cost, what we think that is going to cost. Ultimately, we're coming up with a plan. That's what a budget is. We're just saying, okay, this is a plan for what these costs are anticipated or expected to be. And more specifically, we can start thinking about things like, okay, if we produce X number of units, what is that going to cost? How much marketing? How many marketing dollars should we throw at that? What is going to be the cost in terms of, we think about like overhead, raw materials. What are all the costs? We're going to do some planning, and just kind of look into the future and say if we can plan out our costs and put together these budgets and so forth. But managerial accounting isn't just helpful with planning. It also helps when we think about decision making. Okay, so now we say, okay, well, we looked at the cost to produce a number of units, but should we go ahead and sell those same units to a customer who maybe offers a certain amount? Let's say somebody says, we'll give you $1,000 per couch. You manufacture furniture, so you got couches, $1,000 per couch. A customer offers you, and they say that they'll buy 500 couches. Now you might think, okay, well, how do I go about determining whether I should sell for $1,000 a couch? Now we can talk about things like supply and demand. We can talk about what the market, what we think we can charge. We can talk about all those things. But at the end of the day, at a minimum, we should be able to get back our cost. We should not be selling that couch for less than what it cost us to produce it, unless we had a really compelling reason to do so, like market penetration or something like that. But typically, you want to, at a minimum, have this benchmark and say, okay, does this $1,000 a couch, does that match what it costs us to basically produce a couch? And it's not so easy to figure out how much it costs to produce a couch because there's all kinds of costs that maybe can't be directly traced to this couch. Maybe there's marketing expenses, there's headquarters expenses, there's all kinds of things. We don't just think of the material cost of that couch, and we have some decisions to make in terms of what we'll actually include here. in terms of cost X, cost Y, cost Z, which ones are going to go in. But ultimately, we're gonna plan and we're gonna come up with some kind of idea about the cost to produce those couches, and then we're gonna make a decision about whether it's a good idea to accept this customer's offer. We're going to use managerial accounting to help us make that decision. Now, managerial accounting is also very useful when we talk about directing and motivating. And again, this kind of gets into this idea of that we can allocate costs through this process called cost allocation. And this is where it's really going to get into the motivating. You might think, well, how do I motivate my employees, or how does cost allocation or managerial accounting, how does any of this have to do with motivating my employees to do their job? Well, let's think about this for a minute. Let's say that you allow your employees to take paper. Okay, they can take paper from work and they can use it at home or whatever. You just take all the paper you want. Well, if you don't charge them for that paper and just say, okay, this is free, well, what are they going to do? They're going to take a lot more paper than they would if they were being charged for it. So now you can think about, okay, well, if I charge them for this paper, if I say, okay, now there's going to be a cost to it, they'll behave differently, because then they'll start saying, well, wait a minute, I don't want to just take all this paper because it's actually going to come out of my salary. And it's the same way with cost allocation, right? We can think about, for example, if you have multiple divisions, you have your firm. Sorry about that. You have your firm, and you have, let's say, you've got 3 different divisions, and you go ahead and you say, okay, well, we've got utility expense, we've got a light bill, we've got all these utilities, and we just get a bill at the organization level, right? I just get some bill, I'm the CEO, but these different divisions, they all contribute in some way toward that utility. Now, am I going to split up this utility cost among these different divisions here? Or am I just going to say, you know what, just ignore that. That's not your responsibility. Well, if I ignore it, if I don't allocate this cost, then those division managers and so forth, they're going to behave a lot differently because they're not being evaluated on that cost. So maybe they leave the lights on. Maybe they don't care about reducing the utility expenditures. But if I allocated these costs, now all of a sudden they have a reason to pay attention and try and make sure that these utility costs are as low as possible. So we're kind of motivating them and changing the way people behave based on what costs we allocate, and this is a subset of managerial accounting, is cost accounting. So we can also think about controlling costs. When we think about controlling, well, what do we mean? Do we just mean controlling spending? Well, to an extent we do. So what we're talking about here is we can look and do things called variance analysis. Now, variance analysis is a whole topic in and of itself, but in a nutshell, basically what we're doing with variance analysis is we're saying, okay, what was our planned spending? Okay, what was our planned cost here? What did we expect that we were going to spend on the raw materials or whatever? And then what was the actual cost? What did we actually spend? So think about it this way. You say, okay, well, I think I'm going to buy 100 units or spend $1,000 on raw materials to build these couches, right? So I'm going to spend $1,000. That's the budget. That's the plan that we talked about in step 1. But then we find out that actually, after the period is over, we look and we say, okay, well, we actually spent $1,200. So now what we have is we know that we overspent here by $200 more than what we actually set out at the beginning of the period. So now we can go about and think, okay, let's analyze this and let's think about are we doing a good job controlling our costs? Now maybe there's a legitimate reason for this $1,200, and after we've analyzed it, we go ahead and say, you know what, that makes sense and is fine. But this is it's basically giving us a way to kind of like highlight this and analyze and say, okay, here's something that we should be looking at. We've got this difference here, and it might be an area where we're doing a poor job controlling costs. So we're basically using managerial accounting and this variance analysis tool to help us control our costs. So lastly, we can think about managerial accounting in terms of performance evaluation. Now remember I said we can look at the firm potentially as different divisions, right? If you have different divisions at the firm and you have division A and you have division B and then you have division C, right? Maybe one makes couches, one makes love seats, and so forth. However, you split the firm up, and you look at these different divisions, and you say, okay, how do I evaluate the manager of Division A versus the manager of Division B and C? How can I go ahead and measure that? Because if we just look at like the income statement or something like that, that's for the entire firm. Okay, that's for the whole firm. And maybe, we're the CEO, and maybe we don't, not that we don't care about what's going on at the firm level, but we want to dig deeper and say, let's go ahead and let's see if we can compare these managers to one another and see if they're doing a good job. And what metrics do we compare them on? Well, that's up to us, right? If they have some kind of responsibility for generating sales, and then they also have responsibility for some costs, we might come up with like kind of a divisional profit. We might say, what's the profit of Division A, the profit of Division B, and the profit of Division C? But if they don't really have any responsibility for sales, and all they're really doing is basically manufacturing something or whatever, and it's really just they're just kind of responsible for costs, then we might just look at costs. And we can come up with whatever kind of metrics we want, because this is managerial accounting. It's just done for internal purposes to help us run this this furniture manufacturing company. And so we can create whatever metrics that we think are useful, and none of it has to follow GAAP.
Free.
Okay, that was a little bit longer than I'd like for an introduction video, but it gives us the basic material of what we're going to be talking about over our 15 weeks of this course. Managerial accounting, budgeting, evaluation, variance analysis, costing. Those are our key topics of this course that we'll be talking about. Quite a bit different than the debits and credits and financial statements of financial accounting from what you took for many of you last semester, and many of you from me. But that's the nature of our course. We'll be talking about that in detail in our class on Monday. Please take a look at our syllabus, take a look at the Blackboard, take a look at Chapter 1, and we'll be ready to go Monday morning. I bet you all forgot how exciting and fun accounting was after your vacation break. Yeah, right. But I look forward to working with you all. It's been good to see everybody again. I hope you and your families are well and healthy and safe. And I'll look forward to seeing you Monday morning at 9:25. Have a great weekend, everybody. See you then. Bye-bye.